Peter Rose, Longwood Currency Trading. It's a rather chilly mid-March 2021 day, and I wanted to, I've got some stuff to do outside, that's why I'm going to drag you along with me, a little travelogue. But I wanted to address the issue. I've had quite a few comments about the videos that I've done where I've talked about having a hard and fast rule of a hard 8-pip stop on my trading on a 5-minute time frame, and so I wanted to kind of address that. But first, to address the weather, you can see my wood stack that I would normally take inside as part of the wood pile out back is getting down there. I need to get out tomorrow and get some more wood in. But if you look at the snow that's out here, you can see we're starting to form some patches up in the woods on the line up there behind the house. And if you go down the hill, we're 2 miles up a hill and on the mountain, and if you go to the bottom of the mountain, there's no snow. They have very little snow. Even the snow in the woods, when you look off the road into the woods, is down pretty far. So we're getting close to spring, I think, here. My wife's vegetable gardens, we just have a couple of small patches to do vegetables in because there's just so much you can do. She's got flower beds all over the place, so she wants to do that. But I wanted to come out and show my wood pile situation because it's been a while since we've checked the wood pile. But I wanted to talk about the well, my insistence on having that 8-pip hard stop. It's not an 8-pip hard stop. It fluctuates. The reason that I do it 8 pips is because I happen to be on a currency pair on the 5-minute chart where the ATR indicates and its movement when you get into chop and stuff, that an 8-pip stop is going to show that you're wrong. Well, I'm in a trade right now. I was a trade earlier today. I lost on that one. I'm down about 0.3% on my bank on that. And I'm in another trade right now. It's underwater a little bit, but we're just going to let that run. But I don't have an 8-pip stop on the current one because the ATR has changed. The structural components of the price action have changed, and so has the wood pile. You'll notice it's gone. Yep, we went through that whole 2 chords so far. We just went through gradually with that. So now we've got another 2 chord or 2.5 chords, something like that, to go. I just wanted to come out and make sure that the covers had stayed on that other wood pile, because overnight we've had some strong winds. They've been like 35 miles an hour. I wanted to check that out. So I'm checking the tarps that are covering the wood because of changing conditions. I have to change that hard and fast rule of a stop when the underlying conditions make that evident. I mean, look, if you're trading on a time frame where the ATR is on a 5-minute time frame and you've got a 20-pip ATR, an 8-pip stop doesn't make any sense. I mean, I'm getting comments from people that aren't really listening to what I'm saying. Don't bother to call me to have me help you with mentoring or anything because you're not fucking paying attention. Okay, you got to use the stuff that I'm talking about as advice on how to think about your own trading. You can't be calling people or writing them or taking courses from people that are going to give you specific do this, because trading doesn't work that way. If I work with somebody, their psychological makeup as well as their approach to risk and all the other stuff has to be taken into consideration before I can say, well, maybe you ought to try thinking about this particular scenario that we're looking at in this way. What do you think about that? How do you think things are going to run out? Let's look at some back price action to take a look at that. I mean, I don't know. That was the vet calling to see if we're on schedule to bring the bow dog in for for his spring shots. Oh man, that's going to be another $150 for the bow dog. But you can't use this stuff that we talk about literally. It's all situational dependent. Now, the reason that, I mean, I've been doing, this is my 85th or 87th video or something like that. You go back a year ago to some of the videos that I'm running, it's been an 8-pip stop, and I come all the way through, it's an 8-pip stop. Well, the ATR on that particular time frame hovers around where it is. It's about 5 pips, and it has been that way. It changes. It'll go to 8 pips. It'll go to 3 pips. It depends on the time of the day. I mean, you look at that chart right now, and you got a 3-pip ATR because it's, you know, it's 1 o'clock in the afternoon Eastern time in the U.S. So the traders in London have gone home for the pound dollar, and our guys are out to lunch. So, you know, you're not going to get any ATR. And I'm in a freaking trade. And that's why I'm staying in the trade, even though I'm underwater, because now I got to wait until somebody west of here wakes up and they start trading, and they need to transact some business. Now, there was some very, very heavy institutional business that went on about an hour ago that ran the price against me, and now it's just chattering. And well, that business is done. So I'm waiting for the reaction to that business, and as price comes down, when it goes, I'm on a short on it, when it goes below where I've entered, not gonna increase the position on an anticipatory thing. Now, I'm not working my way out of a trade. I will be staging in to the trade in best practices, the way that you do when the thing runs against you to start with. You don't go in with your full load right away if you have any kind of hesitancy as to the momentum of the price and how far it's going to go. I mean, there's 2 kinds of entries that you need to talk about, and this resolves around this 8-pip stop thing that we've got. There's two types of trade entry that you're going to get involved in. One is the stuff that I've talked about before, where you check the momentum of the price action, and when it looks like it's got enough juice to carry it 10, 20 pips, you know, then you can think about taking a trade as long as other considerations are in place. Well, the other type of trade is more structural in nature. You look at the surrounding price action that's happened in the past, not, you know, if you're on a 5-minute trading chart, you don't really give a shit what happened 10 hours ago, because that guy that was trading 10 hours ago, he might be done with his campaign or whatever he needed to do, or the traders that were trading 10 hours ago may not be the same traders, retail traders that sit at their desk right now. So you have to balance the structures on the different time frames that you're looking at. In any event, price is moving, say, upward, and it's kind of a gradual thing. Well, then the momentum really doesn't factor in as much as the structure does. Well, what kind of structure are we talking about? Well, you talk about levels, where price has congregated, for lack of a better word, in the past. If I'm trading on the 15-minute and 5-minute time frames, then I'm going to be wanting to know what the daily structure points are. And then I may refine that with throwing some 15-minute structure in there. But for the purposes of me trading that day, for the 2 hours that I'm going to be trading, or the 20 minutes, I mean, I did a trade today and I was up. I was up, I don't know, $300, and it took about 20 minutes or something like that. And, you know, then I decided to get back in and do another trade. I had a great risk-reward situation. It didn't work out, and so I'm $100 down. But the levels where price is congregating, whether it's a resistance congregation or a support one, those are your kind of your guides as to whether you're going to have a good trade entry or not. I mean, look, if price is going up and strongly, and you're convinced it's going to continue to go up, although not quickly, but it's going to go up, continue to go up gradually over a couple of 3-hour period of time. So you put some limit orders in there. You have to be cognizant of whether you're bumping into a resistance area. Have you got a resistance area that's within 20 pips? If you do, you don't want to take that trade. You say, "Well, Jesus, there's 20 pips between you and the resistance zone." Well, no, there isn't, because that's exactly what it is. It's a zone. So for you to take an 8-pip hard stop or an 80-pip hard stop, it doesn't make any difference. You're going to get stopped out because price may not make it to that point or before it rolls around and starts to head back down toward the support line. Those zones, I mean, you look at them, and those zones can be 10 to 15 pips wide. I mean, that's 5 to 7.5 pips per side, up and down on either side of them. So you have to be really careful if you're looking at a trade entry situation where you're nearing a resistance or a support zone, and you're not basing the trade on a momentum, but on a structure. Well, you got to watch out. You can't do that. So for someone to say, well, we trade the zones, and the price is moving up and it's moving toward this zone, and so you should get in it. No, you can't. The time where you want to enter the trade, if you want to do it statistically, you want to pick it up about mid-zone. If you're mid-zone, then you got a lot of room. Because if it starts to go in that direction and you go, oh, I'm in, and then it falters and it comes back, stop yourself out right away, because it may be going the other way. You can always get in at the bottom side and ride that to the support zone. So you'll make up whatever that loss is by the distance to the zone. And if you're talking about daily zones, shit, man, some of those are 50 pips, 150 pips apart. Yeah, so on some of the charts, I generally just look at the USD-based charts because I'm in the U.S. But you go pound dollar, dollar CAD. I haven't traded yen, so I don't. I look at it, but I don't understand that the economics of that culture. So I'm hesitant to trade something that I'm not familiar with. But you can still draw the zones on there and see how price reacts to it. I mean, before you do any kind of trading at all, that's the first thing you want to do is take the pairs that you're trading, look at where price action is in relationship to the different zones, and then look at that as a potential trade for the day. But don't be looking at each individual chart saying, oh man, price action is really going good here and I got a lot of momentum. Blah, blah. Don't even waste your time doing that. Just look at the chart. I came in this morning early and pulled up a chart and looked at it and said, there's nothing to do here. I'm not going to do that. I left the chart going and I answered some emails and did some stuff and had to get the dog ready to go out and all that kind of stuff, and came back and sat down and sipping my coffee and looked at the chart and, oh well, hey, there's something going on here. And 20 minutes later I was $300 up. So I was going to quit for the day, but the price action looked like it was going to carry through. It wasn't too late in the morning. I had another couple hours to go before the noontime thing, and in fact I had more than that. And so I thought, well, I could get another trade in. You can get away with making 2, maybe 3 trades a day, and you're okay. But when you make a decent amount of money, it's very difficult not to say, well, I could do that again. But the decent amount of money, you got to remember, comes from some very significant price action, right? And so how many significant price action moves during the period of time you're going to be sitting at the trading desk are going to happen? So you have to ask yourself, when you get a decent payday, push back, shut it down, step back from the table, unless you've got some really, really good price action. And I had some good price action. I lost that second trade. I lost as much money as I had made before, and then some in about the same amount of time, about a 20-minute time frame. And I mean, it hit my hard stop, and out I was. So I was going to try to clear, so I was up a little bit, but I'm trading with some weight right now, and so just a few pips makes a lot of difference in the dollar value. So I just clipped it, and good thing that I did, because it went way against me. But it didn't go against me because I wasn't in the trades. It doesn't matter. And so I've been waiting all morning again with the stuff just sitting there, and I thought, well, okay, we're going to turn around now. We've seen this not explosive move, but a very significant move up. There's some evidence that there's stalling going on. I see that when the price reacts, it reacts pretty strongly and then gradually chokes its way back up. So I think that whatever the institutional trader was that was running that price up, he's finishing off for the day, and when the next team of traders comes into play, they'll say, well, we don't need that. We need to collect that inventory now, and so that's the plan. We got to have a plan. So part of that plan will be not an 8-pip hard stop, because of the price action surrounding that, where some fool out there could go, oh, we've got some we've got some stop limits, let's grab those, let's get some more inventory. I think they're falsely referred to as stop hunts. They're not stop hunting, they're looking for inventory. And if you don't understand what I'm talking about, you need to do some study, because this is how the market works. And it's not working based on what a bunch of retail traders are going to try to teach you in videos or courses and shit that they're doing, because they don't know. They don't understand this stuff. There are very few traders that are looking at what's going on with the dog in this thing instead of us, the tail. So you need to switch that around. But look, in these videos that I do, you have to put them into the relationship with the price action that I'm seeing at that particular time, or that is long lasting. For example, if I've got an 8-pip stop and a 5-pip ATR, you can't say, well, you're a 1.5 ATR stop. And that's not the case, because if my ATR was 100 pips, I wouldn't want my stop to be 150 pips out, right? So you just have to really understand how to put your stop. It has nothing to do with structure alone, or a hard stop point alone, or indicators alone, or price action alone. It has to do with so many of those things in combination, and that's where the experience comes in. But because these guys that are out there selling you courses know that that's not what you want to hear, that you want to hear a hard and fast rule, at 10 pips peel one lot off and let the rest run for the next 15, or whatever the hard rule is that they're talking about. That isn't the way that they trade once they get a significant amount of money, and it isn't the way they traded when they were learning how to trade themselves, if they even really are traders. I mean, it's hard to tell. But you need to really balance what you hear with what you need to do, and are you getting all of the information? In my video, I just say it's a hard pip, 8-pip stop, boom, and I'm out. What I'm really saying is that in proportion to the current price action, if it goes against me, in order to hit a normal structural point or whatever, it's going to have to go far more pips than I really want to spend the dollars on to find out that I'm wrong. I'd rather be wrong 2 or 3 times in a row on a short stop and then pick those up as well as then some on the time that I do win. That's how I trade. And that's why I'm a day trader, because I can do that. I've got the time in a compressed mode where I can run multiple trades in a day or over a 2 or 3 day period of time, just go boom, 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 so that aggregate over the day, I'll have a good win-loss ratio and a good dollar number that I've made, because I'm working with the law of large numbers, not just trading once a day, or once 2 or 3 times a week. And I don't get to take advantage of the law of large numbers. And so if you're not having your trading over, if you're not doing day trading where you have access to not only seeing what those law of large numbers is going to provide you for an edge, but also being able to experience that on almost a daily basis. If you're out on the longer time frames, it'll take you a year before you can develop any statistics that are worth anything. Well, how are you going to learn how to trade? You'll be broke by the time you get done. You can't learn it on a simulated system. You can't sit there for 2 years. I did this. I traded sim accounts for 4 years. I had great stats. They didn't translate into real-time trading. So if you're watching my channel, and I appreciate you, by the way, those of you that are, and I've had quite a few join the channel in the last month. That's great. I love it. I hope you're all serious about it, and you'll be good subscribers and watch my stuff all the time, and not just subscribe to the channel to subscribe, because I don't need subscribers for numbers, for Google Analytics or anything else. I want to be able to help as many folks as I can, so I hope you stick with the channel and you appreciate it. And then and you don't need to comment, but send me an email and let me know what your thoughts are, and I'd be happy to get back to you, and we can chat about this stuff. Until then, please don't take everything I say as concrete. It's a process. So you just watch the body of my work, communicate maybe a little bit with me through email, so you can understand what that process is, so you figure out how you can think about it, okay? Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.